I would spend at least 3/4 of my day on the acquisition side. So I worked it out maybe 5 years ago in business that I'm not a natural salesperson. Obviously, customer service and client services, it's not one of my strong suits.
When I look at my commercial assets, when I look at the number at a P&L level, it's black. Everything else is red, despite the fact that mortgages have gone up considerably.
With the economy where it's at, rising rents, like we said, I don't think you'll be making a bad decision buying in most capital cities if the cash flow is good enough.
Okay, hey, going Phil Tarrant here. I'm the co-host of Inside Commercial Property, where we talk about commercial investing. It's what we're about. We've been doing this now from the deep, dark days of COVID. I was only sort of driving the kids to school this morning and it reminded me that we're now 4 years into when I probably first heard the term of COVID, which would have been January 2020. So 4 years on. And the impacts of COVID still remains, whether or not there's any impact on commercial property. We can have a chat about that today, but I'm sure a lot of people would say yes, there is, because most organisations are still working through this work from home scenario. And as a result of that, the value of office blocks are a lot more subdued than what they used to be. And I know there's a lot of people still struggling with that. A lot of big retail investment funds who invest in commercial property still struggling with it, scratching their heads. But we spoke about that last time we got together on Inside Commercial Property. You can go and tune into it. Lots of things for cover as we kick off 2024 with Scott O'Neill. He's the founder, he's the CEO, he's the director, he's probably also cleans the toilets there over at Rethink Investing. Scott, how you going? You well?
Very well.
Yeah.
Welcome back from holidays, mate.
You're good with suntan.
Oh, just a little bit of surfing down the south coast, one of your favourite areas.
I actually saw you. You're you by yourself with mates, right? I saw you at the farm. It's really You popped up on my feed as normally you sort of yibbiting on about property, but and I just went, I know that hill.
Yeah. Have you surfed down there?
Yeah. Farm's cool.
It's a good spot. It's nice and quiet compared to Bondi. So
I bet you it is.
That's why we go down there.
I remember the farm was when it was actually a farm. Now you got to drive through new build suburbs to get there.
Yeah.
Shore Harbour. But I remember when it was generally a farm and you had to drive down a dirt track to get into it through some old guy's land. Back in the good old days.
How good.
That was good. It was good back
there's
then.
so many good spots down there. It's an expensive little market on the property front, because that was one of the things from COVID. Everyone, bought a holiday home there or decided to move further out of Sydney, and it's ridiculous. Some of I saw there was a unit for sale, it was a 3-bedroom thing for $4.5 million down there.
In Kiama.
And you think,
see, Kiama's gone down a lot. Like Kiama went nuts during COVID, talking about COVID and I guess impacts of property markets. It's more resi than commercial, but there's a lot of people who are maybe negative equity in Kiama these days.
Oh, there have to be. Yeah. And that's one of the things we always predicted. All these guys were running out with the low interest rates. They're going to buy a holiday home, but then you've got to keep paying that insurance. The rates went up. Maybe you don't want to holiday in that same spot forever. It starts to sort of, the shine washes off very quick.
Shine wash. And people still want to go overseas, and pretty much all of my, other than you sort of surfing at the farm, all of my sort of feeds coming in social media, which I try and avoid, to be honest. The only reason why I have it is to keep abreast of stuff that we do here. But it's everyone skiing. Like there's all ski feeds of everyone sort of.
Lots of commercial investors are in Aspen right now.
There's a lot of commercial investors are in Aspen, and it's a pretty expensive property market. Yeah. No doubt you'll be expanding out there at some point in time, getting yourself a lodge or somewhere or other.
Bit of ski trip instead. Yeah,
it would be good. Maybe you should be shouting a ski trip. We can go out there and go to Aspen and get a late season out there. I can't ski. I'm more of a single stick sort of bloke, not a two bloke. Yeah, I can ski. I spent my time snowboarding. Now I'm a fair weather, like I'm much a fair weather surfer. I'm a fair weather sort of skier or boarder. It's got to be really, really good. Otherwise, I don't do it, which is a bit sad, but. It's good to see, mate. There's lots for us to cover in 2024. What's going to be the big themes for us for 2024?
I'm already feeling it. This year's, if I had to quantify it, this time last year, I'd say 50% of our very large client base were not super active to buy within the next 3 months. So there was a lot of people sitting on the fence. That's now shifted to probably 75% of them really want to buy right now, like in the next 3 months. And we've actually done a couple of little surveys and stuff like that. So we have quantified that. And the theme is when rates are going to drop. This time last year is how high they were going to go. So that is the biggest difference. There is talk there's going to be a bit more stock because a lot of people are kind of, it's been 3 years of low stock now, low investment volume. So, same with the residential markets. There's just going to be a little bit more choice out there for investors. I think there's going to be a window in time where essentially we've got vendors meeting the prices of the market, because last year a lot of them were just holding off selling, so transactions didn't happen. As we discussed in the last podcast, volumes were just so far down due to the disparity between what people wanted to pay and people wanted to sell at. So we're in for a pretty good period, I think. I'm acting on it from a business point of view. Like we're rapidly expanding in terms of hiring more people, and I think we've got to get ahead of this because I think we're going to be short of time, really, because of the extra volume that should come through, and it's just due to more positive sentiment.
So I hear around the traps that you might be doing a bit more resi. And that's on the basis, you kicked off with a resi portfolio, and it's well documented. It's in your book. We've spoken about my portfolio, the Smart Property Investment portfolio, which we share for the purpose of sort of showing how to do it. It's resi, and we pivoted into commercial at a point in time. And I want to use that as a bit of a theme. But are you making sure that you're able to cater for resi investors to get them sort of moving into the market before you shift them into commercial type assets? Is that a business focus for you?
So in terms of the business decision, number one, we were never out of resi, but I'm putting more of a focus on mostly because there's a few reasons to it. So one of them is the commercial markets are getting more and more expensive. So there is a point where you need more and more money to do well in commercial. So if you're rocking up with 100, 150 grand deposit, residential is going to be better for you. So we're founded on residential investing. Like we've done thousands of transactions. So we believe we're very good at it. It's how I started with my wife. It's how basically all my staff started as well, which we'll go into. And, I think it's also a good time to get into resi. We're coming out of, a bit of a softening in some areas.
I never thought you'd say it. He's back in resi.
I'm back at certain price points.
There you go. That's what I expected you to answer that.
100% commercial forever. But you really got to kind of build yourself into a position to get into the right commercial. So we're not here just to flog, substandard stock. Like I've seen what others do in the market, and they're going just sharp yielding properties just because they want to get in because it's cheap. I'm not for that. I rather just make my clients wait. But if they're literally short of the deposit needed to buy well, it's either residential or stick your money into a fund, commercial fund maybe, but then you lose the leveraging benefit. So residential, if you buy the right asset now, you'll do quite well in the next few years, because the minute those rates drop, happy days. We're going to be looking at substantial growth. The rents have been going up for the last few years at rapid rates. These are the things I always loved when I was a residential investor. I would find with the rents, you target the kind of the tight vacancy markets, because the tight vacancy market's going to push growth into rents. As the growth and the rents happen, the yield will increase. As the yield increases, investors chase the yield, demand increases. So it's an early indicator of future demand when the rents start growing. So I think that will push values up for the next couple of years, and I think it's
so the play then, and I guess how you're configuring your business is you're still orientated towards long-term wealth creation, leveraging commercial property, but you got to start somewhere. So you're better, I guess your thesis is you're better off deploying that dough that you have right now into a residential asset because of market conditions at the right price point, and get the uplift there for building for a commercial transition in time, which we've done.
Exactly. Look, if there's one thing we're known for over the years at Rethink, we're portfolio builders. So we want diversification in your portfolio. It doesn't mean just let's go buy 12 industrial properties because industrial's flying at the moment. It's not how we operate. We want to actually create long-standard, diverse portfolios that can withstand multiple different types of markets. And no one knows what the market's going to be like in 10 years. So you've got to diversify somewhat. You don't rule out retail right now just because industrial is performing better, because industrial might have an oversupply in 10 years. So imagine you've got those dozen or so properties there, and you're going to get smacked all at once. So residential's a part of it. I think it's just, and this will go against what most residential buyers agents preach. You don't keep going down residential. That route, it's almost, it's a fool's quest. You're going to run into cash flow problems. It's not an efficient method to retire because the yields are too low. So anyone that kind of goes beyond that fourth or fifth residential property, I think they're making a mistake. You need to transition into commercial if you seriously want to retire. If you're happy just buying and working forever, go for your life. But you need commercial to balance out your residential. And you do need residential to build equity as well, because not all of us are going to have a strong business behind you or, some inheritance. Like, you've got to get the money somewhere, and that's normally saving over long periods of time. Yeah. Residential will aid that.
Well, having your money in the savings account, not doing anything is probably not the best way to create wealth. A lot of people would argue. So if the strategy is, maybe that can help sort of shape a lot of our thinking and how we communicate and discuss different things around commercial property this year, is this sort of baseline strategy of get started in resi and then pivot in commercial. The question is, when do you pivot into commercial? We can discuss that. And getting started in resi means buying the right assets with a view towards that longer term strategy in mind. So properties that you can either get significant uplift in capital growth to extract that equity and or realise some sort of capital event through a sale of that. You say the right sort of price points. What sort of price points for resi property at the moment are you looking at?
I'd say under 750, but definitely under 600K, and I think if you're in those price points, like, you can make quite good gains. You can still buy in capital cities, a house. I'm not a big fan of units or anything like that because of the supply issues you're always going to run into. You've got to target properties that have some owner occupiers in the market, and, one bedroom units don't often have that. So I think residential, like I said, it's got its place. And my biggest tip is, ask around. Don't always, everyone's got a residential buyer's agent, and they're going to keep you into that mindset. This is why I bought probably a dozen or so more residentials than I should have, because everyone tells you to keep buying residential because it's great leverage and all that kind of stuff. But you do need to talk to a professional commercial investor just to balance the conversation out. And that's obviously why we've got this podcast. We're here to educate them so maybe they can question their residential buyer's agent. And it goes with us because residential is, like I said, it's got a time and a place, but it has a use by date too for most investors.
Yeah, and a lot of people say, I feel that, you've been around property for a long time and you've got a portfolio. It's not a small portfolio, but it's not as big as the portfolios that I know other people have. And they go, what would you do differently? And I always say there's two things. I wish I'd started earlier. And that's just a philosophical thing. I don't wish I did really, because I quite enjoyed what I was doing before I actually had the responsibilities of properties, and it's been good to me. And the second thing is I wish I did more when I started, because I could have and I didn't. I probably could have bought at twice the speed in resi, but I'd probably overlay that now. And if someone asked me that same question again, the third point would be, I wish I got into commercial earlier as part of that portfolio journey. And, the Smart Property Investment Portfolio, which I share on this podcast, which is a portfolio we built for the purpose of showing people how to do it. They got to 20 resi properties, right? And price points from, 400 grand at sort of last year, 400 grand to 1.3 million bucks, right? So a reasonable spread, well purchased. All the properties did really, really well, and we've sold down that a little bit. But I would have gotten to commercial earlier, and I've been in the commercial now for a couple of years or so, and that's where I'll be sort of spending my dough moving forward. However, I'm the only reason why I'm in the position where I can think about that in hindsight, but also look towards the future, is the fact that I invested in resi first, and that's the way to go. So I think that'll help sort of shape 2024 for us, how we discuss that, thinking strategically. So it's not just the tactical purchase of properties, but it's the why and what you're going to get out of it moving forward. But you spoke about building your team, Scott, to be supportive of it, and I sort of subscribe to your point that I think And what a lot of stuff I'm reading right now is that there will be a surge in price growth again. There will be a sustained period. It's not going to go crazy, but it's going to be a sustained burn of a price growth moving forward. And I can see why you're sort of looking to support your client base with resi purchase. But I saw a comment on something that we were doing the other day, and it was a fair comment. It was quite complimentary, but it pretty much said, and I thought I'd bring it up with you because we don't hide anything here, but it pretty much said, this podcast makes you think that you're probably going to work with Scott at Rethink if you choose to use Rethink Investing, but it's not always the case. It's likely they're going to be working with one of your team members. What do you say to that, mate? So I know I've worked with your team members. They were actually better than you personally because they're a bit more responsive and
that's the thing, isn't it?
You know, but you know, you got the challenge of a successful growing business.
Well, the best way to answer that, I'll explain what I do in my day. So I would spend at least 3/4 of my day on the acquisition side. So I worked it out maybe 5 years ago in business that I'm not a natural salesperson, and so obviously customer service and client service it's not one of my strong suits. Where I'm best at is negotiating deals. I can see the value of a commercial property, within minutes of looking at it because it's literally just all I do all day. So you can, the square meter rates off the top of your head. So I'm negotiating a lot of deals. And I do it also with locals too. So we've got, a guy in Hobart, guy in Sunshine Coast, guys in Perth. We're all in the capital cities.
You've got guys with planes that fly around Australia, right?
Yeah. Mike, our rural guy. But essentially, we all work together and we're negotiating on deals. And then they get fed to what we call a client strategist or property strategist. And then we send a property one-on-one to a client that meets that brief. So we're a scaled business, but quality control is the number one way to get the best result for as many clients as possible. If I'm there sitting to talk to every single client, we'd do 5 deals a month, but we're doing 40. So, and the quality of those 40 is really up there because number one, I'm involved in signing off on the deals and stuff like that. So, yes, I'm definitely available to talk to many clients when they ask, but a lot of them don't ask because they're happy with the guys they're talking. And a lot of the guys working for me, they won't say it publicly, but they're self-made multimillionaires as well. A lot of them don't need to work, and that's a great thing because they don't have commission breath as well. They're not there just to get someone into a sale. And even if they were, that's when the next stage of our business kicks in, which is the due diligence team. So our due diligence team essentially is there to find problems with the deal, and they don't get incentivized if it settles. Yeah. So they don't care if it settles or not. They care if they make a mistake or miss something. So the business is structured in a way that quality is the number one priority, and that's how I fit into it. And then the rest of my time, I'm spending it, growing the business, new ideas.
I thought you were going to say cocktail receptions and that sort of stuff, drinking champagne.
Oh, no. I wish.
No. But it makes sense, right? You've only got so many hours in a day, so you're best deploying your talents where you're going to get the maximum impact and upside.
And the property front is definitely that, not keeping in the back of my mind, I haven't got back to that person in time. You'd be in the same in your business. You got to really be efficient.
Because, I spent all my day going, I don't want to block things being advanced, and often, the people think they need to elevate stuff up to you and you go, okay, I'll get onto it. And it doesn't get done immediately, or you don't really understand or appreciate the time sensitive at all.
I remember sending that commercial property to you and it was like, where's Phil? Need him. It's going to get sold. And you get stretched so far that even something personal and important like that, it's you know where to be seen for days sometimes.
Yeah, and with my team or people I work with, say if it's sort of property investment type stuff, I say if it's really really important and you need an answer straight away, text it to me because I'll probably get back to that pretty quickly. But if it requires some thought or whatever, it's going to have to wait till later in a day when I'm sort of outside of the cycle of the madness of the working day. So there's a hot tip. If you're working with buyers agents, tell them how you operate and they will hopefully shape the way in which they communicate. Well, you just got to let them know the parameters for getting the job done, because I always go, I want this done, get it sorted out. Well, you got to be invested in it anyway. Okay. Thanks for explaining that. And it sort of makes sense, right? And it's good to see that the business continues to grow and evolve. It's because you always find good people to come and work for Rethink Investing. I understand. I've met some of them over the years. Most of them are okay. And I didn't go to your Christmas party this year, unfortunately, which I would have liked to. It looked a bit fancy, but the team's growing. One of those team members, Sid Widge, has been waiting patiently in the sidelines as we've sort of, had a chat for about 20 minutes or so. He joined your business a little while ago, but this is a great sort of case study and story of someone that started off being a property investor, decided property was their passion, they turned into a career, and then eventually they joined Rethink. Sid. How you going, mate?
Good, man. Good.
Thanks for your patience. Yeah. Did what do you say makes sense? Is that how it works with him sort of out there, probably being the boffin in the background, sort of assessing the deals, and guys like you probably go out there and do actually all the hard work?
Well, look, I think Scott's pretty good. So I was a past client of Rethink as well. So
Okay.
I knew him before, how he works.
Are you one of these sort of quiet self-made millionaires who've made a fair bit of dough through property?
I don't know.
It's okay to say yes. Yeah.
But yeah, I've been investing in property for a while and I love doing that. So yeah.
So what do you do at Rethink? What's your job
So
now?
my role at Rethink is a property strategist. So like Scott was describing, there's the acquisition side and there's the property strategist side. So we work with clients and we'll basically help them come up with a strategy, understand their goals, where they're at, what they're looking to achieve, and then kind of give them a bit of a plan of what type of asset to buy, what not to buy. If they've got an existing portfolio, then we'll review it and kind of give them a bit of guidance. What can be kept, what should be sold, where can you get equity from, and how can you make that leap into commercial if they're a first-time commercial investor. So it's really about kind of giving them that strategy on how to kind of get into commercial property and just guiding them through that. And we're basically the front end of Rethink to them. So we'll communicate with them, we'll go through everything. Obviously the acquisition guys and the due diligence guys work in the background, but we're the ones who will communicate and make sure that they're sort of getting what they're looking to achieve.
So you run point, you sort of steer the conversations with the client, getting an understanding, appreciation where they're going, the strategy they're looking to embrace, and then, sit at the intersection of presenting properties to them and supporting the deal.
Yeah, exactly. I think the first thing I do is try and understand their goals. A lot of them probably have vague goals, and my job is to try and kind of get them to narrow down their goal. And once I understand that, it's a bit easy then to kind of recommend a path. A lot of them will come and say, oh, we've heard the podcast and we just want to buy a commercial property. Okay, why do you want to buy it? What's the reason? What are you looking to achieve? And once I understand that, it's a bit easier then to kind of go down what they're really looking for and what they're trying to do.
When you ask those sort of cascading questions, do most people have an answer, or they go, I never really thought about that before?
Yeah, look, a lot of them do say that, I just want to make some money out of it. Okay, then you kind of just have to dig deep. Okay, why? Are you looking to achieve something specific? Is it kids' school, private school fees? Is it, do you want to retire early? Do you want to fancy overseas holidays every year? Like, what is it that you are wanting to buy the asset for? And, likely when you start sharing some examples, then they, okay, I want to kind of achieve this. And then you can kind of, hone it down to, okay, all right, this is what you're trying to achieve. So then, how long do you think you have? Like, what's your time frame? Once you understand that, then it's a bit easy going, okay, you should buy, start with this, and then kind of carry on. You also have to understand the financial position, how much funds they have available as well. Once you have all that, then it's pretty easy from there to come up with a bit of a plan for them.
Is there anyone who has an objective which isn't making money?
Oh, good one. I haven't come across anyone yet.
Because I know a lot of people they go, I love property. You go, why do you love property? You get down to it, people love property because they want to make money. Right, that's what it is, right? And this is the problem, I think, with what you have with a lot of commentary and TV around property at the moment. People think it's actually, soft furnishings and pillows and the livability of it, which is one aspect of property. But every single person I know in property want to make money through property as quickly as possible to save for what would be some sort of retirement and the optionality. Yeah. It's probably a better way to frame it. Everyone invests in property for the optionality of being able to make decisions in the future because they have a bit more dough in their back pocket.
Yeah,
it's as simple as that.
Yeah, it's just a vehicle, right? Like shares is a vehicle. I think property people can relate to a bit more because they can see it. It's physical. They understand it. It's just a vehicle to get you to your goals, really.
Well, the share market's rebounding at the moment. I look at my portfolio every day and it seems to be performing a lot better than what it was a year ago. I might have to put everything in the share market now instead of this commercial property lark. But it goes back to the point, no doubt, Sid, you went down this pathway. You're a commercial property investor, yes?
Yes.
Okay, but you started off in residential investing. Tell us about how you got to where you are from a personal portfolio perspective today.
Yeah, so I started about 10, 11 years ago. Started off in resi. I think at that time, there wasn't much education or knowledge around commercial investing in general. And to be honest, I probably wouldn't have had the funds anyway to start off. But I think what sort of triggered it, what was my story was I went to a business networking event and met some interesting people there. And I think the seed was planted then of kind of getting out of the 9-to-5 rat race and achieving financial independence. That's what
sounds a bit sort of rah-rah seminar type thing, right?
It actually wasn't. It was actually a network marketing event, which I wasn't keen on at all. I wasn't interested, but I just met other people there. And one of them suggested to get into the Rich Dad, Poor Dad book. And there was another book called The Slight Edge. Great books, by the way, if you haven't yet read those two. And Robert Kiyosaki's whole theory is about having passive income, generating that passive income. So that kind of led me to a path of working out how can I do it. I looked at shares, looked at property, looked at a lot of things, and in the end decided to go with property because it was a bit easier to kind of go with, and the banks would favor them more. You could leverage a bit more than you could with shares. And then, I just started reading a lot of books, attending seminars, trying to understand a bit more about property.
So that's a pathway which is well trod, and you find a lot of people have this. There's normally catalysts which sparks a passion in property, and it could be something like that. They go to a property show, or they run into someone at a barbecue at a kids thing, and they're wealthy because they've got all this money in property. So there's normally this flashpoint, right, which ignites people's passion in property. Then they absorb themselves in education. They tune into a lot of podcasts, stuff like this, and they get obsessive about it. And you find that property investors, you must see it all the time, Scott. These people go down this journey, get obsessive about property, and then they do nothing, right? They'll spend 2 years educating themselves. So the hot tip is as soon as you have a degree of confidence and capability and you've got the funds to be able to do it, I'd get moving pretty quickly. Back to my point, because there will be a point in time in your investing journey when you said, I should have started that 2 years earlier than you can do. So, this is this notion, I guess, this doctrine of kicking off in residential property investing with a view towards leveraging into commercial. Because as Scott said, there's a point in time when you're going to start thinking about that optionality of retirement. And, large residential portfolios can be quite a suck over the years. So, balancing it out or pivoting into commercial is pretty key. But, starting off in resi investing, you've spoken about it, Sid, you need to have those financial goals. You need to know what you want. You've got to go about associating yourself with the right people, understanding the investment, go through that pathway to drive forward and position yourself so you can actually move into commercial. But as we know, most people only buy 1 or 2 resi properties and they get stuck. And that's the fortune favours the brave in property investing. But most people who invest in property buy the wrong property to start with, and I imagine that's a catalyst for creating handbrakes. You see a lot of that in clients that you work with who are stuck in resi properties that don't really perform, but they really want to move into commercial.
Yeah, you see that all the time. I think it's I don't know what it is. Like it's probably a lack of awareness as well, and a bit of fear there as well. But a lot of them will. It's a mindset thing. Like they'll buy 1, they'll buy 2, and then when the first hurdle comes, or the bank won't lend you, or it's too hard to work with the broker, they'll just stop. You really need to have that drive to get past that hurdle. Once you do get past that 2 to 3 hurdle, that's when I see, that they'll go ahead and buy 6, 7, 8, and they'll keep buying, and they'll work out ways to do it. There's different ways to do it, right? Even when you hit a borrowing capacity, there are different ways. You can go to second or third tier lenders. You can borrow in sort of different entity names. So there are ways, but it's only those who have that drive, who really want to get to that goal, will go and explore those and therefore cross that sort of barrier.
So this very much, getting it right and surrounding yourself with the right team. You can do it by yourself. I know a lot of successful property investors, or go down the pathway of leveraging a really talented team, and they'll help you with the market analysis and property selection, and supporting you with financing strategies and giving you a good lens towards risk management. How do you diversify your portfolio from the front end? How do you manage your property through property management? All the legal and regulatory considerations around it, and that lends itself to resi, to commercial as well, and also to help you shape your investment strategy with a view towards sort of economic factors and economic indicators which may shape or determine how property markets are going to move forward. But Scott, you made the point, you unravelled quite a large resi portfolio to get to calibrate it to a point where you were comfortable with holding and retaining resi properties, but having a commercial strategy. When do you know you're ready for commercial, and how do you make that transition?
Well, I think the first time the banks start pulling the rug from under you, when you've got a fair bit of equity in your portfolio and you can't lend on it, then you haven't set it up properly, because you shouldn't have too much lazy equity in your portfolio, and then the banks see it as an inefficient portfolio, and then you can't lend. And
what's lazy equity?
Lazy equity is when you've got so much equity in there, the return on equity drops, because basically you've got too much cash flow. You're lacking the leveraging benefits that you initially had, it's not really getting offset by greater returns. So there's three main regrets I had.
The utility of the equity that you have.
Yeah, exactly. And you do want debt in your portfolio. We've always said it. Even if you had $100 million in cash, you'd at least split it to buy a $200 million portfolio and let the bank do half of it. Then you've got 200 million growing, a silly example, but it's basically that. You need to leverage. Every fund manager on earth does it, because they're always thinking, how do I maximize the internal rate of return for investors? And that's what they do.
More skin in the game.
Exactly. So, and the three regrets I had as an investor was, one, buying a unit. So I worked that out too late. That was, I think, my first or second property I ever sold, because it was, eastern suburbs of Sydney. I quickly worked out it wasn't growing as quick as the house in Sydney, and basically there was strata and all the problems that brought. My other regret was buying a development property when I'm not a developer. I literally bought the whole duplex site thinking this is before commercial. I was looking for answers, and I thought, I don't want to keep just buying boring old houses, because I've seen the result. It does well, but I'm not going to retire from this stuff. So how can I maximize the return? And I jumped into development. It's not my skill set. It was literally just going to end up building two, townhouses anyway. So I'd have to sell them and pay tax. I guess I like the idea of development more than the result of it. And I didn't have the budget to play in a space where developing made sense as well. And my third regret was not getting into commercial earlier. The same regret you had. If you got the cash and equity, which sometimes you need to sell to get that equity back, or at least sell your lower yielding ones to free up capital and free up lending standards, then you can actually turn your portfolio around. So I just learnt by making mistakes, and the banks told me I was making mistakes. The returns told me I was making mistakes, and I had to sell and pay the price to get out of those situations.
Yeah, and it's not an uncommon regrets that most people have been in and around property a little bit, and there's a reason why people probably pay the money to use a company like yours. So you're buying the mistakes, you're avoiding mistakes through cold hard cash that other people have made to get a better portfolio creation earlier on, which gives you more options into the future. I guess that lends itself, Sid, to scaling a portfolio where I don't know the makeup of your client base. How many of them are first time investors versus they've got a number of properties and they're looking to scale? I imagine you've mainly got scale-based investors inside of Rethink.
You probably get about maybe 30% are first-time investors out of the clients that I've dealing with at the moment. But yeah, that's probably a good split. A lot of them do have some sort of a property, resi or commercial before.
Yeah. So what's the best way then to scale a portfolio? How do you, with an eye towards increasing equity and leveraging your assets, it's a well-trod path. There's no secrets here, but what do you see works? No doubt simplicity is best.
Yeah. Look, I think a couple of points that Scott touched on were trigger points for me to actually start to transition from resi to commercial. And one of them was I also started to, once I started to build a portfolio, I dabbed into development, bought a house that I could subdivide, got a DA. But the numbers just afterwards weren't stacking up, even though at the beginning it looked like they were. And my stock standard buy and hold houses have done better than, when I've tried to do the development type. The other issue you get with a lot of resis, and I'm sure all of us are aware, is the maintenance and the headaches and the tenants. And it was just getting to a point where you've got multiple properties that it was just getting, I was getting slightly annoyed with all the things. There was enough equity in there. And I think to reach my passive income goal, it was going to take a while, and I would have to start selling things. Then you have to put CGT into mix of things, which no one really talks about at the beginning. They're like, oh, you need 12 properties paid off by 24, sell 12. It's never that simple. So for me, it was understanding that there's better cash flow and I can reach that goal of mine a lot sooner. In fact, I can exceed that goal by having the same total asset value that I have today. And then it was just about a strategy on, okay, I've got enough equity. The banks are allowing me to pull it out. I'm going to pull it out and I'm going to start. And now I'm basically at a point where the commercial properties are providing a lot more cash flow than my whole resi portfolio, even though I've got some very high yielding resis because I bought it a while ago. I've got granny flats. Now I'm slowly starting to dispose off those resi assets, so I'm not liable for too much CGT year by year, and then sort of pivoting towards commercial. And I think it's that sort of slow approach. So it will take some time, maybe 5, 6 years, maybe 7 years. I don't know yet exactly to sort of transition to a level where I want to get to. And I'll probably get to a 65-35 split, maybe 65 commercial, 35 resi. I'm probably at the opposite right now. So yeah, I'll always keep a little bit of resi, including my home, obviously. But yeah, there's no right or wrong here. It's kind of the way I'm sort of flipping it and transitioning to it. Yeah.
And again, that's a very similar story that I hear from other people, and myself included, where you end up with quite a large resi portfolio, and then it just becomes fatiguing. Where it's so fatiguing, you just go, I don't want to deal with it. I'm sick of it. You're constantly getting harassed by property managers. Oh, the PowerPoint's broken, or this is broken, or the roof's leaking. I got a bill the other day. I got a ceiling fixed inside a garage because it was water damaged, and it's water damaged again. So the roof's obviously leaking. And I get a quote to fix the roof for like 20 grand. I'm like, nah, that's like, just get some silicon, bog it up. So it's like, but it's expensive, right? And that sort of frames a negative sentiment when you look at the P&L of it, and each one of those costs is, yes, it's a tax deduction, but you still got to find the cash to pay for it, to get a tax consequence when you do your tax return at the end of the year. It can be a pain, and it's just proper. Like, people are going to be listening, a lot of people struggling trying to get in the housing market, and they're going to hear some property investors going, oh, woe is me. I've got this big property portfolio and I've got to manage it and pay money for it. But it can be a pain, it can be fatiguing. When I look at my portfolio, which I'm a lot better at administering these days because I've sort of, I spend a bit more time on it. When I look at my commercial assets, like when I look at the number at a P&L level, it's black. Everything else is red. Despite the fact that mortgages have gone up considerably, mortgage rates have gone up considerably on commercial assets, I'm still in the black on it, and I have nothing to do with it. Nothing at all. I get a statement once a month. There you go. Yeah. Things are okay, Phil. Don't worry about it. And I go, this is good. This is good, Scott. It's what you need.
Yeah, but look, to throw a negative light on that, you'd still get that with commercial. Like I'm dealing with a few large maintenance items, and
you got to put a new fryer in the chicken shop, do you, or somewhere or other?
Or one of them I've got to spend, and there's a benefit to this, of course. Like we're looking to spend about $700,000 on remodeling a shopping centre to then expand the shopping centre so they can pay more rent. But you still got to come up with that cash, or it's not going to happen. So. There's it still can give you, concerns and that, but there's commercial properties like the one you bought, like an industrial strata warehouse. Not much goes wrong with that. The roller door and the roof might go every few decades. It's simple. But if you buy an old shopping centre or, a giant multi-tenant industrial facility that's 40 years old, get ready for the maintenance. But the good thing is, you have that equation that starts off in the black. So you might be 100, 200 grand positive per year. You got to spend 50 of that on a small new roof. So at least you're ahead.
But these are CapEx, right? Which is different to some of the other costs you might have inside of, and you could say the same in resi, but you just don't get it at the same, you don't get it at the same cadence it feels. If it happens, it's big, but it doesn't happen a lot. But you got the tenant offsetting a lot of the expenses around outgoings and stuff, right? And
exactly.
That's the benefits.
So yeah, there is a difference, and it's the tenant paying the maintenance, which it does make a very big difference. And like Sid mentioned, if you've got 6 or 7 or 8 of these things, it's very comfortable knowing that your positive cash flow is a lot more predictable. because at least that side of the equation is on the tenants. CapEx is not. That's on you. But technically, if you're spending CapEx, you most likely increase in the value of the asset. So there is an argument you could go refinance it post CapEx expense, and
or get an uplift on rents, right?
Yeah.
Which is what you do in your
or you
shopping
tie it in and negotiate a new lease as part of fixing the roof. Get a 5-year lease out of it. Who knows? There's many ways to sort of spin that.
There is a number of ways to spin it, but it comes back to the point, and I don't know if there's a definitive answer to it. I'll ask you both individually. When is it time to move into commercial? What's the signals that you got to look out for? You sort of mentioned, when you get fatigued with this sort of stuff, but is there a hard and fast rule that it's time?
Look, not at all. It's really up to the individual's risk profile, what job they've got. Like if you're a high-paying specialist doctor, a lot of them could just go straight into commercial because they want to replace their income. We have a large amount of medical-based clients, and they have these incredible incomes, and a lot of them don't spend a lot of time on their finances because they don't need to. They're protected by that salary.
Just on that, and it's good because if you're a high-paid medical person, the predictability to generate income into the future is pretty much a given, which is very different to other professions, right? Yep. You don't have that. You just don't have that predictability. You can assume predictability based on the success of your business, but medical professionals swap time for money. So they go, well, I've got 20 years and I know I can get this much, a surgeon, for example. Well, what sort of dough, like, a good surgeon or a good sort of, not a GP, but a specialist medical profession, how much money do they make a year?
Oh, look, I've seen 500 to 2 mil per year, depending on where they're at. And a lot of them, my experience with them is before they've come to me, they've bought 6 off-the-plan houses.
Mate, they make it. A lot of medical professions that I meet make such bad property investment. Like really smart people. And you just go, what are you doing?
They're protected by that income. If you're getting paid 2 mil a year, a house doesn't sound expensive. You got the deposit every quarter for that again, and often their partner is a medical professional too. So we deal with a lot of married surgeons or anaesthetists and who knows what. But basically, they're in a very comfortable position. They often have very large expenses. This is a massive generalisation, by the way.
They probably don't spend their money effectively, right?
Yeah, they've got a very nice car, 3 kids in private schools in Sydney, and all of a sudden that large salary after tax is it's mostly accounted for. So they're not saving huge amounts, some of them, but when they get into their 50s, like the alarm bells start going off, and generally our clients are in their 50s, I'd say on average, early 50s. And it's because they need to start thinking about the retirement. How can I replace the income? So maybe that's the way to answer your question initially. When do you go to commercial? When you really think it's viable to start replacing your income. If you keep going down the residential route, you're not going to replace your income.
Yeah, it's a really good point. And that's probably the signal that, look, the point being, you can't actually have these types of conversations about investing in commercial property unless you've got a big chunk of cash through an inheritance or some other mechanism. You need to manufacture that money somehow in order to get started, and manufacturing that money by saving it is going to take you quite a long time. It's quite a long time. So if you have those savings that you have deployed in a residential investing, you get the leverage effects of it. So it means that you can control more value by having a loan connected in with it, but you're conserving that money also in an asset which should be going up in value if you're investing correctly. So everything absolutely comes down to property selection in resi property with a view towards pivoting into commercial to replace your income. But, if you're earning $1 million a year in 2024, if you just index that by CPI and you've still got 15 years left to work, like you got to do some pretty heavy lifting to get commercial assets to give you $2 million a year.
Yeah. Yeah, no, and that's why the sooner the better. And a lot of them will then end up selling their residential investments, like Sid's story. It's a classic one. And he's doing it in a very strategic way, which is perfect. Like, I love the idea of just selling off incrementally, spread your capital gains tax. I'm in the same boat. I'm doing the same thing. I've still got half a dozen residential properties I don't need or want to own. And the goal is just to, sell and then get into more commercial that gives me a quiet day. You know, it's not so much building a future income, it's just getting rid of the assets that are headaches and just smooth, you know, assets like what you've got. You know, they don't, you can own 100 of them and have the problems of, you know, 10 residential properties, but you got 10 times the asset base. That's sort of the ratio of effort.
And the ratio of effort to the outcomes that you want, or the impact of that decision making is critical. We've done that recently on a smart property investment portfolio, where I think we sold 2 properties in June of 23, and we sold 2 more properties in July of 23. So 4 properties sold in the space of 2 months. However, it falls into 2 different financial years. And this is why you need a really, really good accountant as part of this. You know, if you've been holding on, depending how you hold your resi properties, but if you've been holding on resi properties and accelerating the growth of them from a capital point, but extracting equity, you might have some retained losses inside of that. Right. That portfolio or inside that trust, which can be leveraged to offset capital gains tax. There's nothing wrong with that. Yeah. That's just the way it works.
Correct. And I've seen a lot of clients lately.
That's not advice, by the way. That's just an example.
A lot of the situations, once you factor in capital gains tax, this is another note. Again, talk to your broker and your accountant at the same time. It's often better to refinance and then just put the money into it and then retain that asset, because if you sell, go through all the efforts, pay a sales commission, you know, do all that stuff, and then capital gains tax on top. Sometimes you're not that much worse off keeping the thing. You've just got to deal with then leveraging off that, which means 100% debt on the deposit. So the cash flow is a little bit worse, but then you've got a larger asset base. And if you're secure in where you are and you think interest rates are fine versus the yields you're getting, hold it all.
Yeah, I actually just did that myself, and I'm settling on this month. I was going to sell a couple of properties up in Queensland just to support raising the deposit. It was a pretty big deposit, and I looked at selling them, and I went down the process or pathway of doing it. I was speaking to a buyer's agent who wanted them off market so they could provide them to the clients, and I got to the point where I just went, I'll just refinance them.
Not worth it.
I said, I'll just refinance. I don't want to deal with this. Don't want to have to deal with the tax consequence, and I don't want to have to deal with the selling. It just annoyed me, and I just went, I'll just refinance it. Even though the refinancing, it's a slightly higher mortgage that I'm paying on it right now, and it's changing lenders on this particular asset I'm thinking about. But when all said and done, the money that I was going to extract from it, less tax consequence around it versus getting the immediacy of a refinance and deploying that money into another deposit. I was like, well, it's against a property which is in a good area in Sydney, which is going to continue to grow and evolve based on what we're just chatting before. And I just went, yeah, I'm happy to top that up to 80. In a couple of years' time, we'll be back to 60, 55% LVR. And I went, yeah, it's cost of doing business, right? The cost to hold that property now is going to be more expensive because it's got a larger debt against it, but it's ameliorated by the deploying of that money into a new asset, which gives me that growth. Resi, by the way, it's not commercial, but this is the sophistication it gets to. But you don't get to play this game unless you start, right? And that comes back to the point: how do you get started? Unless you've got a lot of dough, you're one of these medical professionals, and you can get straight into the commercial. You've got to start somewhere, and that's a resi. So you'll be. And this will be shaping a lot of our chat sort of moving forward. It's not a new thing, by the way. We've been chatting about this for years on this podcast. But how best do you create a strategy today, which is resi first, commercial second, and just actually understanding when it's time to shift and move? And that's going to be shifting sands for people, right? You might say, I might be 5 years' time, but you might be able to accelerate that. And would that be an objective to try and accelerate your move into commercial earlier? I guess coming from you probably would say, yes, it is.
Yeah, look, if you want to retire
you might say
quicker,
5 years and you want to bring it back to 3 and 4.
Yeah, if you want to retire earlier, commercial earlier, like as we both said, it's one of our regrets. We held a little bit too long, but you need the equity to play. And residential's a great spot, especially now, like with the economy where it's at, rising rents, like we said, it's, I don't think you'll be making a bad decision buying in most capital cities if the cash flow is good enough. So you just got to pick the right assets. Don't go into those high-rise units or the off-the-plan houses. Like there's a lot of effort and marketing out there for seminars pushing people towards that stuff. So, and my 2 cents on off-the-plan, 4-bedroom house or 3-bedroom is you're paying a premium for a new product. It's like a new car. You don't get the discount. There's a lot of similar stock. they quote great growth rates in those suburbs because they've literally raised the average capital value of the suburbs. Because if you build 100 new homes, those 100 new ones are going to be probably a little bit more expensive than the 5,000 old homes there. So the average lifts because they're part of the transaction volume. So a lot of people will confuse you with stats in that space, and this is why it's risky. If you buy good old standard existing stuff, it's a little bit easier to do well.
So you reckon good price points are sub 750? Let's get some secret sauce. Where are you buying then, Resi?
Look, all the cheaper capital cities. So your Perth, your Adelaide. We're still into Brisbane. I think that market's just got a good decade ahead of it.
Any specific suburbs you can give us? Are you going to hold that stuff?
Middle ring suburbs.
Middle ring.
Yeah.
Here we go. What about you, Sid? You're probably a little bit more comment. Middle ring Brisbane suburbs. Okay, so pretty much anywhere on a train line to the north of Brisbane, but it's good buy now. So you reckon another good 10 years in Brizzy for capital growth? Yeah. And two of these properties I was going to sell were in Brisbane. I went, I'll be silly to get rid of them because I just wouldn't replace them.
Yeah, look, Brisbane hasn't had the most spectacular 12 months. So, you'd rather sell after a real booming period. And it has boomed up there, let's be honest, but it came out off very low points. Like the decade prior to the boom, everyone thought it was going to come 5 years earlier, that growth spurt. That was almost one of the strangest things in real estate, why that market didn't go when it did. Yeah. But it's gone. But there's still legs in it because look at the value of Sydney, Melbourne, average incomes. There's going to be an infrastructure boom up there. So it's not going to go backwards.
No, it's not going to go backwards. But I got in the Brizzy reasonably early and I was sitting around waiting for some time for it to shift because all the indicators said it should have, but it didn't. It took a couple of years before it started moving. But what's next for you, Sid, on your own portfolio? You're just selling down resi, buying more commercial. What sort of commercial stuff are you going to get into? What sort of price point?
So at the moment, I'll go industrial. I think I want to probably go into a different asset class, maybe retail, shopping centres. Maybe childcare. I don't know yet, but probably I'd say 2.5 mil would be the next purchase around that.
Would that be sort of putting down big deposits? Because I know there's a lot of favourable lending at the moment. If you can stump up the stamp duty, they'll give you 100%.
Yeah, it would be a large deposit. It'd probably be 30% deposit on that one. And that's why I'm going to sell something in July because I've already done this tax year's selling. And then the proceeds from that, I'll probably go into commercial. And yeah, look, like you said, there's always that dilemma. Should I sell or should I just refi and keep it? But there's just a lot of equity in there. And if I just refi, I'd just be getting a lot of debt. It just, again, won't be positive cash flow. So I may as well just, it'll just let me hit my goal quicker if I do it that way.
How many people are making debt decisions today based on interest rates where there are rather than looking towards a long-term median on interest rates? And, to the point I was saying is that, you're refinancing at the top of the interest rate cycle. And you go, well, that's going to hurt for a little while, but it should come down over time. How do you have a sort of healthy acceptance of that rather than sort of the immediacy of what it is now, but having a long-term sort of mindset on where it'll go?
Yeah, I always tell my clients, look, you've got to look at the long-term average, right? It's never going to be 2% and it's never going to be 8%. It's around the 5.5%. Yes, in the short period, you'll feel some pain and they're high rates, but you got to look at, it's a long-term asset. You're going to buy it for 10, 15 plus years. What's going to be the average interest rate you pay over that period? And once you kind of explain it in that way, they tend to sort of, understand it a little better that way. And, you average it at 5.5%, and you kind of go from there. That's kind of the way I discuss it. And that's the way I look at it myself on my own portfolio, right?
Yeah. With your own portfolio, sort of just quickly, because I'm conscious of the time, sort of the best thing you've done or the worst thing you've done?
I think the best thing I've done is invested in property and got a portfolio. I wouldn't say the worst thing. I think it's, we all learn through it. Like I've bought a lot of those old houses in Logan. I probably wouldn't buy the old houses again, just the maintenance. I've tried to get into, development and subdivision. I think if you just, they say slow and steady wins the race. Just buy good assets, good houses in good areas, and they will grow. Just buy slightly newer assets. Don't buy 40-year-old Queenslanders. And and look, don't be scared. Like, just because, even up until now, every time I'm about to purchase, I'll always, is it the right thing? But because I know I've done it so many times, I'm like, yes, it is the right thing. You just have to have that, kind of that confidence to go ahead and then push yourself to do it. So yeah.
How do you find purchasing your first commercial?
Look, because I had a large resi base and I'd been researching commercial for about 18 months before I got into it. So for me, I was kind of already mentally prepared. And also, I think it took a while to get the first one, the right one. So when I went through the process, I felt like I already owned one because it took a while. But yeah, look, I've never looked back. Both my commercials have had 7.5% rental increases every year for the last 2 years because of the inflation. So, even with the high rates, and they're still positive cash flow. And the first one I bought at 80% debt, even that's positive cash flow. So yeah, for me, it's a no-brainer, hence my pivot. But yeah, I think you got to get to a certain point. You got to have those funds available to be able to make that switch. If you have the funds from day one, I'd say do it. I mean, it's money in your pocket. It's positive cash flow. Why would you start with something that's negative on day one?
That's fair enough. And the team over at Rethink can have all these discussions, right? Is that where it starts, like trying to work it all out?
Yeah, and just remember, like, when you put a property under contract in commercial, we've normally got 28 days or at least 21 days of due diligence period. So even if you're not 100% sure, I remember working with Sid. He had lots of questions, very detailed, orientated guy, and he was getting the confidence through the process, because you don't know the asset, you don't know who the tenant is, what the history of the property was. But by the end of that due diligence period, you know more than the owner, one would think. And if you don't, you extend it or drop out of the deal if you're not feeling it. So it's not like you're going all in day one. You can sort of play it and get confidence.
Give you the confidence. And that's a tactical point of view. What you're talking about there is that you control the property, right? It means that you sign a contract saying, I'll buy it, which is conditional to ABC. And if you choose to get out, you don't lose anything, right?
Yeah, and you're never going to have that 100% confidence day one. To the point where I've had some clients prior to coming to me, they'd put 4 properties under contract at once. Yeah. So we don't do that, because that ends up just wasting time and money with lawyers and stuff like that. But you can explore your way into confidence. And like I said, if you don't get that confidence, crash the deal, move on to the next one. You've only wasted time and maybe a few legal fees or a building and pest report. You'll survive.
Sounds good. So what do people do if they want to sort of, they're going, okay, well, I'm a resi investor and I'm tuning into this podcast with the view of shifting the commercial, and now it's time because I've had all these inflection points. What do they do? Call you guys up?
Yeah, call us. Our number's 1300 965 551, or just Google Rethink, and you'll talk to guys like Sid and Mike we've had on the show, and others, even Adam that you've had on the show. Like, these guys are all doing what they're doing. They've had residential portfolios, they've done well, they're self-made, and then they've invested in commercial and they love it so much. It's like, well, what else do you do with it? I want to be exposed to this industry more, and that's sort of how we all end up working together. And it's a great experience.
Would you give me a job as a property strategist?
You'd be very hard to manage, I think.
I think I'm probably unemployable these days. Right?
I think so.
It would be hard to manage.
You wouldn't do what you're told, that's for sure.
Yeah, don't worry. I'm not going to do it. I'm going to stay podcasting. Yeah. I'm probably better at doing that than buying property. But thanks for coming, Sid. Good to see you, mate. Keep up the good work. It's good to get these stories, and it's a lot of people also who are maybe potential staff members for you tuning into this, right? Who are down this pathway, because people have this inflection point, understanding the mechanics and machinations of property investing, and they go, I want to quit my day job. But my hot tip is, and I can't remember who made the point, make your money in what you're actually good at making your money at, and don't try and do the other stuff. Like, don't worry about development. Don't keep it simple. Like, you want simplicity is key. Hence the reason why I'll keep doing what I'm doing. I'll pay blokes like you to do the wealth creation bit. Works for me, but if that resonates, you can give the crew over at Rethink Investing a call. Any questions as well? Where do people ask questions?
I'll probably just email info@rethinkinvesting.com.au, and I know a lot of send it through your Momentum Media channels, which is great. You always give the feedback, and it all helps part of the podcast, the feedback, and hence why we brought Sid in, more investor stories, like real people. So we'll keep doing that.
Yeah, and we spoke about it last podcast, just signing off on this, was get some economists and demographer type people in, have a chat with us, get some science behind where to be investing. I've seen some reports I've shared in with you about sort of forecasts and people telegraphing what's going to be happening in markets. So we'll get into that also across 2024. Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.